In order to account for inflation, you should adjust your retirement savings plan. One way to do this is by investing in low-risk assets and/or buying physical precious metals assets, indexed mutual funds, or exchange-traded funds. Indexed mutual funds and exchange-traded funds allow you to diversify your investments so that if one asset goes down in price, the others will still be up. Inflation will reduce the purchasing power of your retirement savings. As mentioned above, inflation is the rate at which the general level of prices for goods and services rises, and it eats away at the purchasing power of dollars over time. Even a low inflation rate can significantly impact future retirement income if it's compounded over many years. For example, if you retired in 1980 with a $100,000 nest egg and annual 3% inflation rates, by 2010, inflation would reduce your buying power to the equivalent of $40,340. Inflation can be measured by Social Security and certain pensions and annuities. However, there are no perfect measures of its effects on individuals' retirement savings plans. Many experts agree that investing in assets such as the ones listed above has the potential to keep up with inflation and is an excellent idea to include in the decision-making process. Several inflation-resistant assets include stocks or mutual funds, TIPS, Treasury inflation-protected securities, real estate securities, gold, silver, palladium, and platinum. Inflation will reduce the real value of your retirement income. Retirees have relied on the 4% rule, but this approach may not work in coming market cycles and more prolonged than expected time horizons. This is according to many experts who say it's an outdated strategy. Even Vanguard has published information pointing out some holes in the retirement income plan. Inflation and higher prices will reduce the real value of your retirement income, so you need to be proactive and make changes to your portfolio. According to the 4% rule, the retiree should start with 4% of the retirement portfolio's initial value. This number is based on research that suggests a retiree can withdraw 4% of their initial investment each year and then add the inflation rate to this amount every year to offset inflation effects and maintain the standard of living they are accustomed to. How can you adjust your retirement savings plan to account for inflation? Why aren't you saving enough for retirement? It's no secret that Americans aren't saving enough for retirement. A study by the Economic Policy Institute found that, in 2013, the median retirement savings for all working-age families was just $95,776. There are many reasons why people might not be saving enough for retirement. People might not be saving enough because they don't have access to affordable retirement plans like 401k or IRA accounts. Another reason is rising prices of essential expenses and healthcare expenses are eating into discretionary money. According to Barclaycard, consumers show signs of the cost of living squeeze, which sees almost half of all the UK card transactions. Barclays notes that virtually all non-essential expenses have declined, ranging from furniture to sporting entertainment. It would be nice if wages were to keep pace with inflation, but they are not. The average person has started weighing the cost of retirement savings versus purchasing essentials. Consider healthcare costs. When planning for retirement, it's essential to consider all the potential costs that come with it. This includes not just regular expenses like housing and food but also healthcare out-of-pocket costs. One of the significant healthcare costs associated with retirement is long-term care. According to Senior Living, the average annual cost of a semi-private room in a nursing home is $94,900, and the average yearly cost of assisted living facilities is $54,000. Home health care homemaker services run about $59,495 per year. Significant expenses can quickly add up, so you must plan for them in your retirement savings. One way to do this is by using an HSA to fund long-term care, LTC, costs in retirement, and HSAs have some significant tax advantages over other methods of funding LTC costs. Another thing to keep in mind when planning for retirement is inflation. Inflation can take a big bite out of your savings if you're unprepared for it. That's why adjusting your retirement plan is essential in ensuring you have money set aside for rising prices over time. Inflation-proof your retirement income. No one knows exactly what will happen with the stock market, interest rates, or the economy in the years ahead. However, it's important to take steps to protect the purchasing power in your retirement from inflation and rising medical costs. Here are a few tips. 1. Review your portfolio and adjust your asset allocation to account for inflation. 2. Consider holding more stocks to take advantage of higher returns, but be aware of possible stock market volatility. 3. Avoid overexposure to bonds in a rising interest rate environment. 4. Consider investing in bonds to hedge against inflation. Bonds are a type of investment that pays you back over time with interest, and as rates rise, the price of existing bonds usually falls, meaning you could lose money if you sell them before they mature. However, investing in bonds also provides stability and can help dampen the effects of inflation on your overall portfolio. Invest in real estate indirectly through REITs. Real estate is often seen as a good hedge against inflation. When prices go up for goods and services, rents usually follow suit. By investing in REITs, which own and operate various types of real estate properties, you can gain exposure to this sector without having to become a landlord yourself. Commodities can provide a hedge against inflation and be an attractive investment for those nearing retirement. Commodities are physical goods, such as gold, oil, or wheat, that can be bought and sold on the open market. They can provide a hedge against inflation because their prices usually rise when the cost of living goes up. Elites are purchasing physical precious metals to protect their wealth from currency devaluation. If you're looking for a more long-term solution, financial analysts are predicting gold prices will continue to increase in the coming years, so it may be worth investing in gold. Remember that investing for retirement is a long-term commitment. When calculating your retirement income, account for inflation. Over time, even relatively small amounts of inflation can have a significant impact on how much money you'll have available to spend in retirement. Optimal portfolio allocation for long-term retirement includes optimizing Social Security benefits as well as other sources of income. Investing in inflation-protected securities can help you protect your retirement income from the effects of inflation. Options for investing in inflation-protected securities include TIPS, corporate IPDs, including REITs, and savings bonds. What are some tips for minimizing the effects of inflation on your retirement savings? Number 1 way to protect your retirement is to check your emotions. One of the best ways to protect your retirement savings is to check your emotions at the door. When the markets are in turmoil, it's easy to let fear or greed take over and make decisions based on those feelings rather than reason. Instead, 1. Asset allocation funds have a diversified portfolio and target retirement dates. 2. This means they will automatically rebalance their holdings when the market takes a downturn, so you don't have to worry about making knee-jerk decisions. 3. Target date funds put your savings on autopilot, with adjustments based on your targeted retirement date. 4. This takes the emotion out of decision-making, so you can be assured that your money is working for you even when you're not paying attention. 5. Follow your investment strategy. 6. When retirement planning, make a plan with a fiduciary, someone who is legally obligated to act in your best interests, not their own. 7. This way, you can be sure that someone is always watching out for your financial well-being. 7. No matter what happens in the market, save early and often. One of the best ways to minimize the effects of inflation on your retirement savings is to save early and often. You can do this by 1. Contributing to a retirement account, such as a 401k or IRA. 2. These accounts have tax benefits and allow you to save money pre-tax. 3. Diversifying your portfolio across different asset classes, such as stocks, bonds, and real estate. 4. This can help reduce volatility and improve returns. 5. Open a self-directed IRA. 6. With 3% 15% invested in physical products like gold and silver. If you're interested in learning more about investing in gold, Gold Hill Retreat has done extensive research on the top gold IRA companies. Review your withdrawal strategy regularly. When planning for retirement, it's essential to have a solid withdrawal strategy in place. However, this plan may need to be revisited as time progresses and your circumstances change. For example, as mentioned above, the 4% rule may not be as reliable in the future. You may want to consider withdrawing 3% instead. Additionally, if you are not comfortable with the CPI, Consumer Price Index, consider using the MSPRATI Inflation Index instead of relying on your retirement investments alone to ensure a steady income in retirement. And finally, remember that medical expenses will likely continue increasing. According to the Peter G. Peterson Foundation, Americans spend nearly $12,000 yearly on medical expenses. So make sure you factor these costs into your overall budget. Keep an eye on the economy. It's essential to be aware of the economy when retirement planning. The stock market has outperformed the CPI since World War II, so it can be a good idea to include stocks in your portfolio. However, Remember that the market as a whole doesn't always rise. It's essential to plan your portfolio based on your individual needs. In addition, you should also include bonds in your portfolio for income and stability during market downturns. Final thoughts. While inflation does not cause your retirement savings to vanish overnight, investors cannot underestimate the damaging effects inflation causes make it essential for you to be prepared and aware of how best to mitigate inflation's impact. Investing in assets such as precious metals like gold or silver bullion can ensure that your retirement funds are protected. To learn more about the best gold IRA companies, read Gold Hill Retreat's in-depth reviews to find out which company is right.